very, very deep thinker in monetary theory, and so we're very, in a very fortunate position to have a senior policymaker actually who has had spent a lot of time thinking very deeply and critically about monetary phenomena. And he's been able to, write or comment on the current wave of cryptocurrencies and the desire for central bank digital currency. I really liked his speech on central bank digital currency. Is it a solution in search of a problem? And of course, very, very thoughtful critique of the proposal. And today he's going to be talking on centralized and decentralized finance, substitutes or complements. So thank you very much, Chris, for joining us here. We look forward to hearing your thoughts on this subject.
All right, well, thank you. It's good to see old friends at this conference. I participated in this conference for nearly 20 years and have often presented my research on monetary theory, banking, and payments. So I believe this is the right audience to speak to regarding the role of centralized finance and the emergence of decentralized finance, or DeFi for short. Now, over the past few years, there's been a lot of attention and work on DeFi, which will be a major focus of my remarks. Many argue that DeFi will replace traditional centralized finance, while others argue that it merely extends traditional finance methods and trading activities onto new platforms. It is in this sense that I want to address the question of whether centralized finance and DeFi are substitutes or complements. Now, advances associated with DeFi have the potential to profoundly affect financial market trading. While I believe these advances could lead to efficiency gains, I recognize the significant value that has been delivered for centuries by financial intermediaries and centralized financial markets. So before I share my views on the promise of these new technologies, let me tell you where I'm coming from on these issues. So I'm an economist, and so my first inclination is to think about the underlying economics driving any issue. But to understand the value proposition of DeFi, it's useful to first recall why centralized finance arose in the first place. Centralized finance clearly provides benefits to people, but obviously has come with some cost. And I'm going to take a few minutes to discuss those benefits and costs before turning to the question at hand. So let's start with what many of you all understand. Let's talk about the economics of trading. Now, most financial trades are pairwise in that the seller of an object needs to find a buyer of that particular object. The problem is that it is often complicated, costly, and time-consuming to search for a buyer. This gives rise to the need for someone to step in and help buyers and sellers match in a faster and less costly manner. In short, there's a profit opportunity for someone to intermediate that trade. Now, another name for intermediaries, as we all know, is middlemen. Why would we pay a middleman? So in their paper from nearly 40 years ago, Ariel Rubinstein and Asher Walensky described it eloquently. What makes the middleman's activity possible is the time-consuming nature of the trade, which enables middlemen to extract surplus in return for shortening the time period that sellers and buyers have to wait for a transaction. So let me contextualize the value of middlemen with an example I used for years when teaching money and banking. Suppose I would tell my students you had some extra income from saving and you wanted to lend it out and earn some interest. How would you do that? First, you'd have to advertise somehow that you have funds available for somebody to lend. Then you'd have to wait for the right person who needed that exact amount to show up. And that could be a long time. And then once you met that right person, you would have to negotiate when repayment would occur. Next, you would need to know a lot of information about the person receiving your funds and the likelihood you would get repaid. This is needed to assess the risk of the transaction and the compensation you need to give up the funds. You would also need a lot of legal advice to draw up a contract and stipulate how the contract would be enforced under a range of conditions. And finally, since you are the sole source of funding, you will bear the entire cost of the default. There will be no risk pooling. So it should be clear that this would be a daunting exercise for most people and explains why they would turn to a middleman who specializes in all these types of activities to do this on their behalf. So it's for all of these reasons that banks arose as early as in ancient Mesopotamia to carry out some of these functions. Similar issues arise when it comes to other ways of transferring resources from one person to another, as occurs with non-bank debt, equities, and insurance contracts. Many point to trades of shares in the Dutch East India Trading Company in Amsterdam in the 1660s as the origins of the first modern stock exchange. Lloyd's of London was founded as a means of pooling funds to share risk and return in the shipping industry, thus becoming the first insurance firm. The fact that similar arrangements still exist centuries later is a testament to the value of intermediation and centralized financial trading. Now, however, these arrangements are not without drawbacks. An obvious drawback of intermediation from the perspective of those wishing to trade is you have to pay them. What a problem. There are transactions costs to using middlemen. Another drawback of intermediation is that you typically must turn over control of your assets, such as savings, your stocks, to the intermediary for them to be traded. This creates a classic principal agent problem whereby incentives between the principal, you, and the agent, the intermediary, may not be aligned. That can raise concerns about custody arrangements and recourse to regain control of one's assets. Intermediation also requires record-keeping arrangements that customers can trust accurately reflect their true holdings. In other words, centralized finance requires a substantial amount of trust. With all that in mind, let me turn to how and why technological innovations have given rise to DeFi. Now, in a capitalist system, the existence of profits provides incentives for others to enter the market, offer a better product, and compete away any excess profits. This can be done by the creation of new financial firms that can provide the same or better service at a lower cost. Often that occurs through innovations and exploiting new technologies. Think about how the invention, going back, of the telegraph and the telephone revolutionized financial trading. More recently, the advent of the internet further advanced the ease and speed of financial trading. These are examples of how financial trading has evolved over time. And the next wave of innovations in financial market trading could be driven by technological advances that alleviate some of the potential drawbacks of the centralized approach. Now, often broad technological advances emanate from narrower efforts to design products or processes that solve specific problems. For example, one technology used to support portable home appliances like vacuum cleaners was originally developed to support the space program in the United States. Similarly, the development of crypto assets led to the development of technologies that are fueling the possibilities in DeFi. Now, we don't have enough time for me to cover the full history of crypto assets, but I will focus on several key elements that have affected the evolution towards DeFi. Now, an early crypto asset, Bitcoin, was developed to function in a world in which trust among individuals did not exist. Trust was transferred from individuals to the technology. Rather than relying on excuse me, I already said that, I think. So the other thing, Bitcoin was designed for privacy. No one would know who was buying or selling Bitcoin. This was achieved through cryptographic technology and private keys. In addition, it allowed individuals to maintain control of their crypto assets throughout the entire trading process. That is, they no longer had to delegate control to others. And finally, all records were kept on a form of distributed ledger called a blockchain, which has design features that promote transparency, and are censorship proof. So no individual or government could destroy the records of trades or take ownership of the objects traded. So with that history in mind, and before we delve into the question of whether DeFi and centralized finance are substitutes or complements, I think it's useful to carefully define some terms. We kind of ran into this yesterday. This will make sure we're all talking about the same things. So as I had described in a speech last year, I think of the crypto ecosystem as consisting of three parts. First, there's a crypto asset, which generally refers to any digital object traded using cryptographic techniques. There's a technology that directly facilitates trading those crypto assets. This includes smart contracts and tokenization. And finally, a database management protocol used to record trades and ownership of these digital assets, commonly referred to as the blockchain, which includes both permission and permissionless distributed ledger technologies. So it's easy to see how the emergence of these technologies could think of DeFi as being a substitute for centralized finance. For example, the technologies are allowing for individuals to trade assets without giving up control of those assets. You don't need custody arrangements. And that's a critical distinction from centralized finance. That would lead me to think of them as a substitute for centralized finance. However, there are other uses emerging from these technologies that look to me more like complements to centralized finance. For example, distributed ledger technology is just a technology. And it may be efficient and faster to do record keeping in a 24/7 world using a DLT, or distributed ledger technology. We already see several major standard financial institutions experimenting with DLT for traditional repo trading of US Treasuries. And that trading occurs now with DeFi or these frameworks 24/7, as opposed to an 8 to 5 Monday through Friday time schedule, which is traditional repo trading. But before these ledgers can be used to facilitate transactions in traditional assets like debt, equity, and real estate, these assets first must be tokenized, meaning they have to take a different physical form in order to trade over these platforms. And undertaking the process to tokenize assets and use distributed ledgers like blockchain, or undertaking the processes, this can speed up transfers of assets and take advantage of another innovation, which are smart contracts. Rather than relying on each party in the trade to separately carry out the transaction, smart contracts can effectively combine multiple legs of a transaction into a single unified act executed by a smart contract. This can provide value as it can mitigate risk associated with settlement and counterparty risk by ensuring the buyer will not pay if the seller does not deliver. Now, while these efforts are still in the early stages, the functionality could expand to a broad set of financial activities. The bottom line is that things like DLT, tokenization, and smart contracts are just technologies for trading that can be used in DeFi or can also improve the efficiency in centralized finance. That's why I see them as complements. Now, stablecoins are another important innovation in DeFi. Now, stablecoins were created in the crypto universe in the hopes of providing a safe asset with a stable value for trading. We always love some safe asset in any financial trading that we can move in or out of as needed. Now, nearly all stablecoins are pegged to the US dollar 1-for-1. They provide an opportunity for buyers and sellers to transact in a decentralized fashion, with the stablecoin used as a settlement instrument. Because they are effectively digital currency, stablecoins can reduce the need for payment intermediaries and thereby reduce the cost of payments globally. But their safety is not assured. History is replete with cases in which synthetic dollars became subject to runs. And stablecoins thus face all the same issues any substitute for genuine US dollars faces. Now, if appropriate guardrails can be erected to minimize run risk and mitigate other risk, such as their potential use for illicit finance, then stablecoins may have benefits and payments, and by serving as a safe asset on a variety of new trading platforms. These technologies will almost certainly lead to efficiency gains over time, but as they develop, we should think carefully about their role in the broader financial landscape. Is it really possible to completely decentralize finance using these technologies? And I would say the answer is obviously no. Intermediation is still a valuable service for the average person. And we see this by the existence of trading exchanges in the crypto world itself. All these platforms evolve means giving custody of your crypto assets to the exchange so they can be traded on your behalf. That's standard, okay? So what trading platforms do in the DeFi world is they simply reintroduce the need for trust in these platforms, just as trust is needed in modern banking systems. Returning to the technologies behind DeFi, one must ask whether there are unique risks associated with the use of these technologies. If so, what is the nature of those risks? Are they contained to just the people directly engaging with the technologies, or could there be broader spillovers to society? For example, can these technologies increase the risk of inadvertently providing funds to bad actors? In centralized finance, there are regulations that require banks to know who their clients are. And similar rules and regulations needed around some of these are similar rules and regulations needed around some of these new technologies. When it comes to our financial plumbing, which affects every person or business in one way or the other, I think a balanced view of expeditious disruption and long-term sustainability is merited. So where does that leave us? Ultimately, I believe that advances in technology have the potential to drive efficiency gains in finance, just as technological innovation has done for centuries. While there are certain services emerging through DeFi that cannot be provided by centralized finance, the technological innovations stemming from DeFi are largely complementary to centralized finance. They have the potential to improve centralized finance, thereby increasing the significant value that financial intermediaries and centralized financial markets deliver. I look forward to seeing the continued evolution of financial technology and the benefits that evolution will bring to the households and businesses served by our financial system. Thank you for taking the time to listen to me. David.
Well, thank you, Chris, for that wonderful talk. I mean, I think it's fair to say the initial endeavor in this space, Bitcoin, this push to DeFi, to decentralization, really did view the endeavor as a substitute to the centralized finance, but leave it to an economist to find the silver lining and to discover the possible complementary aspects of the endeavor. So thank you very much, Chris. I'm afraid that Chris will not be taking questions here, but we look forward to talking with you later off camera. Thank you. Thank you very much.